Hello friends, before I begin this video, may I request a few seconds of your time? No, it's not what you think it is, but it's as important. You see, those of you who've been connected with me for long enough have given me a lot of love and affection and have appreciated my work on television interviews, print and electronic media articles, etc. And you know me as a pure prop trader, which I have been doing since 1986. So you see, we focus on doing things, which is why we have zero idea about digital marketing, about advertising, or how to reach our work across to a bigger segment of the audience. But we want to keep our work free. And just because it's free, it doesn't mean it should not reach out to a whole lot of people. Can we depend on you to give us the word of mouth and other push like sharing our work with your social media platforms, with your social media groups, etc., so that we can reach out to a wider audience and spread the virtue of knowledge? If you can do that, it would be absolutely great for us. Now, let's dive right into the video.
Well, hello, friends. Welcome to the 169th weekly market outlook video. And this is Vijay Bhambwani guiding you through what I expect in the coming week. Well, the reason I have kind of mentioned will bulls experience the March magic in the thumbnail of this video is because March happens to be a special month. It is the last month of the Indian financial year, and in the past, I've made videos about how market witnesses cyclicality in price behavior. So you can actually split the market into hour of the day and day of the week, week of the month of the quarter, and quarter of the year. So typically speaking, the biggest players in the market, which is the mutual funds, they tend to boost markets to prop up their net asset values or NAVs because this would be their annual report card. And as the old management saying goes, there is no other motivation as good as a deadline. So 31st March is a kind of a deadline, a small kind of an examination. And just like we as students used to rush in the last hour, March is the last month of the year, and there is normally some rush hour buying witnessed there. So, will March 2024 also witness this magic? Will bulls be lucky another year round? I think it will be subject to a few conditions being met, and in this video, I'm going to discuss those conditions as well. So please stick with me till the end of this video. Now, friends, I come to the weekly market roundup where we see that the rally was led by the Bank Nifty and the broad-based Nifty followed suit on in a close pursuit. The US dollar index, the Dixie, went up by 20 basis points, and that had a dampening effect on gold, which reacted downwards. Silver went up on some amount of defensive buying. Crude oil went up due to geopolitical reasons, and natural gas fell a whopping 13.29%. This is the third consecutive week when major double-digit falls and on fairly noticeable volumes we've seen in natural gas. And where the USD INR is concerned, which is the dollar versus the Indian rupee, it fell by 4 basis points, which means the Indian rupee appears to be stronger. Another reason why the markets went up. The Indian 10-year benchmark bond yield fell by 1 basis point, which means the bond prices rose. That's actually very good news for our GILT fund portfolios. And I recommended 4 GILT funds to you on 14th of December 2023. Here's how they've fared, as you can see them on your screen. The NSE gained a little under a percent in market capitalization. Market wide position limits went up almost 2%, which is routine till the third week of the derivative series. All three major US headline indices fell, the biggest fall being in the technology heavy NASDAQ. That provided some amount of headwinds to our local markets. Now, friends, let's see how the Nifty fared versus the Bank Nifty. It is very clear that over a 4, 12, and 20 week time frame, it is the broader based Nifty 50 which has been rallying. I have been telling you that financial sector stocks are kind of weighing the markets down due to the sheer weightage. Now, banking and finance has a weightage of 33% in the Nifty, and a fortnight ago also I had made a video to that effect. You can watch this video from the hyperlink in the description and below this video, as well as the pinned comment as well. Now, on your screen now is the chart of the interest rate sensitive counters. You can see that they are also underperforming the broader based Nifty 50 over a 4, 12, and 20 week time frame. If at all you want the March magic to prevail at this time around as well, it is fairly important that interest rate sensitive banking and financial sector services stocks also rise. Do remember 33% weightage in the Nifty. That makes this sector extremely important. Friends, the weekly market roundup done. I now come to our in-house exclusive indicators. I start with the MWPL, which is market wide position limits. This is a percentage exposure utilized by traders as a component of the total exposure allowed by SEBI. Now we are now at 40.53, which is very slightly under previous derivative expiries high point. Will the previous high point be overcome? I think there is a fairly good chance of that happening. And what it simply means is that in addition to emotional involvement and commitment, traders are now beginning to build up positions. And I'm talking about buy and hold kind of traders who don't close their positions at the end of the day. These guys tend to be fairly savvy, and they nurse higher risk appetite as compared to day traders. And these guys are digging their heels. And do remember, high MWPL also translates to high statistical beta or pure price volatility, because bigger exposure gets squared up whenever a surprise is seen in the marketplace. So, on the whole, I think a higher MWPL shows a higher risk appetite. I now come to the stock and index futures turnover, and this is a 3-month concurrent turnover in the derivative cycle. So it is February, March, and April. What you're seeing is turnover went up in the index futures, which are relatively lower risk as compared to stock futures. And stock futures turnover actually fell on a week-on-week basis in spite of the fact that the markets rebound. So intraday trader participation was somewhat lower. We ideally should have had prices and the turnover going up, but we can always keep an eye on this figure. I update these figures every day on my social media accounts, particularly my Telegram channel, which is absolutely free, and that's one place where I put all my research under one roof. Friends, I now come to the NSE advanced decline ratio, which after the price is a leading indicator, which means a fast indicator, which is the exact opposite of a lagging indicator. Now, the NSE advanced decline ratio saw a smart jump to 1.23 as compared to the prior week's 0.94, which means for every 100 losers, there were 123 gaining stocks. And that tells you that intraday traders showed a relatively higher risk appetite. This, of course, is a weekly average of all 5 trading sessions of the week gone by. Friends, I now come to the basis of the prompt month futures series. Now, basis is nothing but the premium or discount prevalent to spot, and that tells you the risk appetite. And of course, as we head closer and closer to expiry, the premium in the futures tends to shrink a little. This is exactly like options premium eroding as we head towards expiry. But the kind of decline that we saw in the bank nifty basis, it's fallen more than 50% as compared to its prior week, and that basically tells you that risk appetite in banking and financial sector stocks is relatively lower as compared to the Nifty 50. So let's keep an eye on interest rate sensitive banking and finance stocks in the weeks ahead. I now come to our exclusive in-house indicator, the impetus, which you have been enjoying for over 3.5 years now. And what you are seeing is that both the indices, the Bank Nifty and the Nifty 50, gained last week with higher impetus readings. That means the rally in these indices was accompanied by higher force, higher momentum, which is a positive sign. Do monitor the impetus. This is again a weekly chart, but on a daily basis, I update all this data on my social media accounts, particularly my Telegram channel. Do join me there, please. Friends, I now share my second exclusive in-house indicator you won't find anywhere on the internet. The Lift Weight Thrust Drag Index, or the LWTD Index. What we are seeing is, in spite of the Nifty gain falling to 1.19%, compared to the prior week's 1.79%, the LWTD index has actually risen. But to be fair, it still remains below the zero mark, which means that fresh buying, although would be mild, I do expect short covering to continue to cushion declines. Now, do remember, short covering may cushion declines, but to propel the markets toward a new high, you need fresh buying, not just short covering. So do monitor the LWTD indicator also on my social media accounts on a day-to-day basis. So far, I think the LWTD is indicating that the coming week is likely to be marginally better than the prior week. Do remember March magic. Friends, my in-house indicator is done. I now come to the market that's very close to my heart, the bond market. I have been kind of talking about bonds ahead of equities for many, many years. And what you are seeing is that the Indian benchmark bond yield has fallen on a week-on-week basis by 1 basis point. And that means higher bond prices, which means there's basically been an expectation that interest rates may not really be cut as soon as the markets were expecting. The price remains below its moving average, but it's still way off the swing low that it made marginally above 7% mark. If at all bond yields were to come down extremely sharply, I think it would be time to ramp up our exposure to gilt funds, and that's something that I recommended in the middle of December, 14 December to be precise, in 2023. We might just raise our stakes over there. I will definitely update you on our free Telegram channel first, so please do connect with me there. On your screen right now is the scorecard of how your 4 gilt funds have fared both from 14th of December to 16th of February onwards, as well as the 1 year returns that these funds have given you. As you can see, they are far higher than a fixed deposit rate of return. And do remember, these are gilt funds. So they are basically investing their money into government gilt edge securities. So you have a sovereign guarantee plus a good appreciation here. So peace of mind plus money. You can't be going too wrong here. Friends, the bond market's done. I now come to the Bank Nifty, which rose 1.64% last week, and it notched up gains on 4 out of 5 trading sessions. The price has closed above its month-long moving average, which currently is going sideways. The two necklines, as I have marked in red and blue, which were the necklines of two previous head and shoulder patterns, are acting as a good support at this point in time. Now, that support is approximately 44,500 level. As long as the bulls manage to defend this level, in case of a decline, they do stand a chance of coming back a little stronger. The weekly chart on your screen now shows the price is above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium term outlook is also positive. The price is above its 6-month long moving average, which itself is going higher, which means there's optimism over the medium term, even on the Bank Nifty as well. The 46,370 level hurdle needs watching in the absolute near term. And should the bulls manage to take the Bank Nifty above 46,370 and keep it there above the 46,370, you are going to see the March magic becoming a better or higher probability in the coming days or coming weeks ahead. Friends, in the week before last, this index was number 7 on our most volatile counters list. It rose by 2 notches to number 5. That means volatility levels actually went up. That's a higher challenge for traders. Last week, I estimated a range between 47,025 on the upside and 44,225 on the downside, which held perfectly well. In the coming week, I estimate a range between 47,825 on the upside and 44,925 on the downside. Also, watch our daily, weekly, and monthly pivots both in equities, indices, and commodity markets only on our free Telegram channel. These pivot points help you intraday and swing trade both across multiple asset classes. Friends, the Bank Nifty done. I now come to the Nifty 50, which rallied 1.19% last week, and it rose on 4 out of 5 trading sessions. The price is above the month-long moving average, which itself is moving higher. So the Nifty looks relatively stronger than the Bank Nifty for another of the many weeks in a row. Now, the Fibonacci level of 261.8%, which is at 22,200 level on the Nifty spot, needs to be overcome conclusively on a sustained closing basis to basically confirm to us that the March magic has begun in all seriousness, in all earnestness. So far, bulls have attempted to break out above this 22,200 threshold twice, but failed. Now let's take a look at the weekly chart. It shows a bullish candle above its 25-week exponential moving average, and that's a 6-month long holding on cost an average bull. So the medium term outlook is also positive. Note how the price has narrowed the gap between itself and the 25-week exponential moving average, which is a very healthy sign. I don't want the price to fall below this moving average, and if at all there is profit taking, the longer it stays above this moving average, the better it is. In the week before last, this index was at number 4 on our most volatile counters list based on statistical beta rankings we maintain in-house. It jumped 8 notches to number 16. Now, that's not exactly very good news. Higher volatility means higher challenges. Last week, I advocated an estimated range between 22,275 on the upside and 21,275 on the downside, which held perfectly well. In the coming week, I estimate a range between 22,550 on the upside and 21,525 on the downside. And in addition to all other data, please do watch our free daily, weekly, and monthly pivot levels only on our free Telegram channel. Friends, I now come to the last bit of statistical data wherein I try to gauge the retail risk appetite by the exposure generated by them in the derivatives segment of the market. Now, index futures turnover remained flat, no increase or decrease in contribution to the Nifty 50. And in the stock futures, what you're seeing is 0.02% decline in the stock futures turnover here. So the risk appetite in the futures segment definitely seems a little off. In the option segment, the turnover contributed by index options fell by 14 basis points. It's shown as a green line, whereas stock options turnover went up by 16 basis points, indicated as a purple line, which tells you that risk appetite in the option segment rose a little bit. But net, I think risk appetite was lower due to the high volatility and retail traders playing a cautious hand. The impending expiry of the series also played a part. Friends, I come to the segment where I share my trading strategy for the week ahead. And since natural gas prices have come down sharply, they've actually crashed. And this is something I've been warning you about on my social media account for months. And I would not want to short fresh futures or try to capitalize on deeply out of the money theta decay strategy in the options segment. I might contemplate buying natural gas if the price falls substantially enough. I will seek theta decay opportunities and strategies in crude oil, which is rising on Russian and Saudi joint efforts, and they are aided by the Red Sea hostilities. Now, interest rate sensitive stocks continue to underperform, so select counters may be good theta decay opportunities, and I expect bullion to get buying support on declines. Metals surged late evening on Friday in the commodity markets, which may trigger a short squeeze or a bear squeeze in some metal counters in the equity markets as well. Now, public sector units, especially public sector banks, continue to remain in the limelight because the trader attention remains focused here. I've been recommending PSU stock trading since many months, and I've actually recorded a special video on the PSUs for you. Do check out the pinned comment below this video and the description below this video for links to the PSU category video. My expectations of higher volatility are being met, even as I have been pointing it out in my live mint column. So I might just cut back exposure levels a little bit just to play safe. And do connect with me on our free Telegram channel, which is one place where I share all my inputs free of cost with my online family. Friends, before I sign off from this video, a reminder to subscribe to our YouTube channel if you haven't already done so, and click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comments segment, do let me know what you think of our work and how we can make these videos even more enjoyable and knowledgeable for you. Also, help me reach out to fellow like-minded traders like yourselves by recommending my videos to your family and friends, including social media groups, if any. I thank you for your patience in being with me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. I wish you have a highly profitable week ahead. Take care. Bye-bye.